Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm going to continue with my series about how to evaluate a stock, and in this part 3 I'm going to mention the formula that was given by Benjamin Graham, and I'm immediately going to say in this video I'm also going to say that he wasn't that keen on this formula, so be aware of that, and I'm aware of it, so you should be too. Where were we at the end of part 2? Well, we were talking about the simplified formula of Peter Lynch. So the simplified formula from Peter Lynch that was invented by me is the future PE divided by PE. So it's not a formula from Peter Lynch, but it's just my way of thinking about it, and these were the criteria. So when you have a value below 1, it's overvalued. Around 1 or above it slightly is fairly valued. When it's 1.25, it's undervalued by 20%. When it's above 1.66, it's very undervalued, and it's with a 40% margin of safety. And as you know, margin of safety is really key. But how do we actually estimate that future PE? Well, there is Benjamin Graham, and he is the godfather of value investing. So he wrote the book Security Analysis in 1934 together with David L. Dodd. So he wasn't alone on that. I think David L. Dodd was actually Benjamin Graham's mentor, and Benjamin Graham was then again the mentor of Warren Buffett. So yeah, this book, you should read it as well, but it's really hard. It's one of the most difficult books that I have read about the stock market and the how to analyze stocks. But you should actually read it when you want to know how you should do it. And then you have the more popular book from Benjamin Graham, and that's of course The Intelligent Investor. This is actually the revised edition from 1972. I have this book on my shelf, and yeah, I like this book also a lot. I read it when I was 14 years old, and I'm constantly rereading it, rereading sections of it as well. I really like this book. I like this book as well, but as I said, it's really difficult to go through. So what he actually says is you should buy businesses cheap, and that's what he did, and also what the young Warren Buffett did in the beginning of his career. But later on, Warren Buffett switched to buying businesses at fair value, and great businesses at fair value is better than buying businesses cheap that are actually not that great businesses, but actually crappy businesses that went down a lot and are actually worth at book valuation more than what they are selling for. So that was what Benjamin Graham was good at. He looked at thousands of stocks, made an estimate of them all, picked out the 200 ones that were really cheaply priced compared to their book value. He went into that, so he needed a lot of money to do that. So he searched around for money a lot. That was what Warren Buffett was doing in the beginning as well. And he bought a lot of stocks, and he lost some with some of them, and the other ones he was hitting home runs on. So his track record was really good. But if he would do that right now, yeah, he could screen for thousands of stocks, and his list would be fairly empty. As I said in the previous video, if you look at the 210 stocks of the 6 stock market right now, I think there is only one stock that is trading at a 20% margin of safety compared to its fair value. And I'm not buying that stock because I'm not trusting my own calculations yet. So even with a 20% margin of safety, I'm not certain whether or not I want to go into that stock. So yeah, it's investing is definitely not easy. And then Benjamin Graham is actual formula for evaluating a stock is the value of the stock is equal to the earnings per share. So here we have again the earnings per share times the 8.5, and the 8.5 is, according to Benjamin Graham, 8.5 is the PE ratio. Oh, I forgot an I here, so it's the PE ratio of a non-growing company, and the G is the growth rate projection for the future. So 5 up to 10 years looked into the future, what the growth rate would be. And then you have 4.4, and the 4.4 is the historical average yield on corporate bonds. So that's a fixed number. It didn't change that much compared to the time that Benjamin Graham wrote his book. And then you have Y, and that's the current yield on corporate bonds. So this current yield in Switzerland, it's pretty low right now. So the valuations would be higher than yeah 4 or 5 years ago because Y went down. And the earnings per share, that's also a question. So which earnings per share do you take? So do you take into account the previous quarter or the previous year EPS? Because right now, of course, the EPS that we received, the earnings per share in the annual reports, they are from last year, so the 12 last months of last year. So the whole the whole last year, of course, but they are reported in March, April. So there is actually already a quarter past, and when they already mention their current quarter, so the last quarter that passed, are you going to calculate with the earnings per share the trailing 12 months earnings per share, or are you going to take into account the next quarter already where they put forward an estimate? Are you going to trust them? Are you going to make up your own earnings per share? That's also a question. So making this valuation isn't easy at all. So if we want to make it easier, you can say that we are long-time investors, so the bond yield for us isn't that important. So the factor of times 4.4 divided by the current average yield on corporate bonds, we can scrap that. And then we can say, okay, what is 8.5 plus 2G actually? And for me, this is then the estimate. Man, I forgot here an S to write, so I made a lot of typing mistakes in this presentation. I'm sorry for that. So I think that's Benjamin Graham, his estimate for future PE ratio. And you can write it like this. So the future price divided by the earnings per share in the future is the future price divided by earnings per share. And what is actual formula is left after scrapping out 4.4 divided by y, you have earnings per share times this formula, but you can write this formula as future price divided by earnings per share. So his valuation is actually, with these two dissolving each other, you have the value is equal to the future price. So the formula for the future PE from Graham is then actually 8.5 plus 2 times G. So Peter Lynch, his formula becomes then future PE changes to 8.5 plus 2 times G. And the newer version of Graham's formula is earnings per share times 7 plus 1 times G times 4.4 divided by Y. So the old formula was 8.5 plus 2 times G. And the new formula, they changed 8.5 to 7 and the 2G to 1G. Because in his first book, there was a footnote to the formula with the EPS times 8 plus 2G times 4.4, where he thinks that this formula is actually not that good for companies with a growth higher than 15%. So you should keep this in the back of your head that in the original book, the formula that I'm using here actually came with a footnote that this formula isn't that great. But still, when I was younger, I thought this formula was great, and since then I always used this formula. And with the new formula, you can change it to 7 plus G divided by the PE. And in the, I'm already investing for almost 30 years now. So I have developed my own PE table versus the new and the old Graham labels. And those I'm going to mention in the next video. So with that being said, I thank you for your attention and for watching this video. Please consider subscribing and hitting that like button. It helps out the channel enormously. And see you in the next one. Bye.